All right, part number 4, the last one for our swing workshop today on December 17th, 2016. Um, we've talked about step-by-step approach as to how we would be finding our candidates. We've talked about the market opportunities, definition of the market, and what specific market environments give us in terms of the opportunity for short-term swing traders, for long-term swing traders, and also for long-term investors. We've talked about the tools as to how we're going to start finding our candidates. One of the approaches that we've discussed was top-down approach, where we're looking from the sector point of view and going into the stock level. We were talking about identification of the leading industry group and identification of the leaders and laggers during in that particular group. And then we talked about the rotational swing trading based on the established uptrend in those stocks. We've talked about identification of strength using just very conventional comparative analysis tools during the market reaction, so that's also is very helpful. So it seems like we could narrow our universe, or we could go in a different way, and we could just establish our universe of stocks right away. And actually, as I was on the break, I saw one of the emails from students was the question for our Monday class, about how we could contract that universe of stocks, even with the top-down approach. You're still going through quite a lot of stocks. I mean, definitely you're going to come up with maybe 20 to 50 candidates at the end, and that still could be somewhat daunting, just going through the structural analysis, volume, supply. So what could you do? You can contract the universe of stocks that you go through in your analysis right away. You don't have to think about top-down approach. You could just say, okay, I'm going to trade only NASDAQ 100, or I'm trading only S&P 500. And that defines the number of stocks that you look at right away. That's why, in a way, for a short-term swing trader, I wouldn't recommend going through the top-down approach, where you will have to look through so many stocks. I mean, just take the IBD 50 and just follow all of the stocks on their list. And sometimes those stocks are going to go off the list. They're being taken away just because of the underperformance. But think about those stocks. If they were on the IBD 50 list, that means that they were outperforming. And if they go down down off the list, that means that temporarily, at least, there is some kind of underperformance. So therefore, you might go into those stocks and just try to see how the structure is going to develop and keep them kind of in the separate watch list. But with IBD, if you're a short-term swing trader and you're trading 2 to 3 days, maybe a week to 3 weeks, these are the stocks where you could use, and you can contract that universe to a very manageable number of stocks. And the ideas about the rotation in stocks among the leaders, because IBD basically leading stocks, is going to be the same. So you can apply the same principle on the rotation of the swing trades that we've discussed in the leading industry groups. All right, great. So let's start our last session with volume analysis. And I'm not going to go through a lot of the in-depth ideas here as to how we look at the volume signatures and supply signature in particular. All of that you're well familiar with. I'm going to just stop on one of the ideas that is going to be extremely important for us in terms of the selection and in terms of the what exactly we are selecting for the type of the trade that we want to see. What kind of volatility? I mean, we've talked a lot about the volatility today. And in this example in particular, we were bringing an example of how volatility contracts into the backing up area. So let's just kind of follow this, right? So increase of the volatility, somewhat of the decrease, increase of the volatility interface, C, increase of the volatility, but still low volatility already. This is where volatility is going to decrease into the backing up action on the change of character, and then as a confirmation of the supply that comes in, we're going to be looking at the low volatility. So the overall idea is just to time the emergence of low volatility and find the places where volatility drastically contracts and then volatility to the upside drastically increases. That's basically the whole idea for swing trading. And how we would use the volume signature. And obviously, volatility idea is all about availability of the supply, how much supply we have in the specific spots on the specific reactions, how much supply, how that supply unfolds during the structure, and what we could expect after that. So obviously, one of the things that we're looking for is the decrease of the volatility and decrease of the supply. And here are some of the schematics that I've created for my students, so you guys have those. And for those of you who don't have those, just take them, print them out, kind of practice on any of the trading ranges. They don't have to be downsloping like I've shown it here. It could be a completely horizontal or even upsloping range. Here is another example. This is a Home Depot example right here, and we're going through this trading range, and we're seeing how volatility decreases. Decreasing the volatility is not going to be only reflective in the supply signature or volume signature itself. It's also going to be reflective in the spread of the stock. So sometimes, and this is how we're going to start the Wyckoff practicum with the exercise on the where I'm going to give you a price chart, but not the volume chart, and you would have to guess or guesstimate what kind of volume signature we're going to have there. And then the second exercise is going to be taking away the volume signature, or no, having the volume signature but not having the price, and trying to guess by the volume signature where exactly we are in the structure and what kind of moves we have. So again, as I was mentioning, kind of like this idea of the universal trader, at least for myself, I strive, to go to the level where I understand the price movement, just from the look of the volume signature, or I understand the volume signature just looking at the price structure or how the price moves. And I think it's very crucial because it reinforces all of the different concepts, whether those are structural concepts or the volume concepts. Well, specifically, what is happening here, right? And I built this slide as more of the exercise. So let's just go to the solution right here. So we're seeing that there is an increase of volatility going in, through the change of character and through this reaction. So we are naturally expecting first some kind of stopping action that is going to occur, maybe even on somewhat relatively climactic action and climactic volume, and then the test of that volatility later on. And most likely that's going to happen in phase B. And we're seeing how supply is contracting and how volatility is starting to increase on the upside, which is a really good sign for us early on in the trading range, because it's basically showing us some kind of strength signature. And the price actually goes as establishing a new boundary for the range. Now, at point number 5, we're not necessarily seeing an increase in the volatility to the downside. It could be just a very temporarily high supply spike that we see. But behind it, we definitely see demand emerging. And the only way how we could say that demand is emerging is only after the fact, after the price actually starts to go up. We also could argue, and again, this is going to be a very fun exercise with the Wyckoff practicum people, we could identify analogous bars that are going to have either the same price signature or volume signature, or contextually they're going to be in the same placement and in the same kind of contextual places. And we could compare them, and looking at these two bars right here, I could say by the signature of the effort that the effort is slightly increasing or staying the same, and yet the result is so much less. So therefore, just based on this signature, we could expect some kind of bullish move out of here. And obviously, further price confirmation comes later. The fact that we are having higher highs, again, in the potential phase B, how phase B is being developed, and the higher low right here, so higher highs, higher lows, suggesting that going into phase C, we are probably going to have a failed spring. And again, you know, this is a little bit of the Romanism, so just keep that in mind. In conventional labeling, we're going to just label it as LPS because it's a higher low. And we kind of see this, and we're seeing how the movement to the downside is contracting here. So it's, you know, definitely showing us that supply is, even though the price goes down, supply is actually not actively provided to the market. And we could measure the volatility also, and there was you know, kind of like a question about this, how can you measure the volatility? One of the visual measurements of volatility is not only just the price movement, but also in terms of the volume itself. Look at the moving average right here. This is a moving average, I believe, for maybe the last 20 bars. Or maybe 50, I would have to check on this. But look at, and in a lot of cases in classes, this is what I do. I want to measure the volatility based on the average volatility and see how the spikes are being created right here, and I'm seeing how there is definitely an increase of the volatility here going into phase C, which is quite acceptable, and we just want to see that volatility to decrease relative to phase A right here. And a local increase into phase C is quite acceptable. What happens next? Well, the first gap comes on the increased demand signature. We are definitely interested in comparing it to the previous instances where the price goes up on the increased volatility. So specifically point number 4 would be very comparable to point number 7. And we are seeing how the price is actually moving so much more on slightly less effort. So that's also very encouraging. We are taking less effort to move much faster and to move more distance. So that gives us a timing tool to say that, you know, when we observe this, most likely we are going to have you know, the price move very soon in the direction of the trend. Point number 9 has a definite signature for both supply and demand, and this is something that we've discussed so much, those volume spikes during the second series in the Wyckoff advanced course, and we were saying that whenever we have a spike, volume spike, and the volume signature increases drastically, it's the element of both. In this case, increase of the demand and increase of the supply. But demand still is going to be dominant over the supply and push the price up. But this increase of the supply suggests that we're going to have some kind of testing action after the initial low. And that's how we would interpret that volume spike. I think that the volume spikes are definitely one of the most frequently asked questions, and I would definitely spend some time exploring that, analyzing, you know, those volume spikes, and we're going to do a lot of that during the Wyckoff practicum course. 11 and 12 are showing us, as we are expecting, the decrease of the volatility. I mean, look at phase C, look even at the change of character after the major sign of strength. And we're seeing how the supply signature here is relatively so low. I mean, the average supply signature is lower than probably anything that we've seen before. Maybe in phase A and B here, we had such a low volatility, but relative to everything else, phase A right here, phase B in the middle right here, phase C here, even phase D has such a more than average supply signature, and 11 and 12 is just a total collapse of the volatility, which basically is saying to us, now I'm going to move, and I'm going to move in a very significant way because supply is under control by strong hands. All right, so, and this is a very interesting question, so let's get some answers. And the question here is, which stock has the lowest volatility during the 2012 consolidation, and what does it mean for the next move up? So we are basically looking into this area right here. Right here. Here, and I should have done this, probably just identify this before, so I apologize. These are the new slides, so I just was working on them last night and before the workshop. So let's have some kind of typed in results here. I want to see what you guys are thinking. You know, which stock has the lowest volatility during the ranges that I've identified, and what does it mean for the next move up? We already know that there's going to be a move up, but we just want to make that correlation. Okay. All right. Great. So answers are coming in. All right. And I'm seeing that the majority of answers are all about Alaska. There are some other answers that we are going to go through, but okay. Great, great, great. Great, guys. Okay, thank you so much. So the majority of you have said that the volatility is extremely low with Alaska. And I would agree on that. So I think it's the lowest volatility that we see among all of the four peers. And you might be thinking of volatility in different terms, right? So you might be thinking, well, how does the price look here? How does it move during the trading range? Does it move, let's say, a rally and then the reaction that almost comes to the point of the low, of the previous low where the rally has started? And in case of the Alaska, we're seeing that it actually rests maybe on 1/2 of the range that it creates with this rally. So there is definitely much more volatility, let's say, in JetBlue than in Alaska. And the same kind of idea here. We're looking at Southwest, and even though there is a definite contraction of volatility in this area, the initial volatility right here shows that there is some levels of supply that coming in, and therefore, you know, the supply levels have the ability to move the price down. So therefore, the next move to the upside might be potentially not as good in Southwest as it is in Alaska. And we'll come back and we'll discuss this a little bit more because obviously Southwest had a really good move. Again, looking here at the United, we kind of have in the same picture. Well, we're seeing that whatever supply is available here, and in this case supply is actually contracting, but what's happening is that the price is being taken down. So there is no active support for the stock, which is also very important for the low volatility. It's not the function of how supply or demand or the volume signature is going to be reflected on the chart. It's the function of the result. So we might have the situation where supply is contracting and yet volatility is still quite present in the price movement. So you have to think in terms of, if supply is not available and supply is contracting, why in the world would the price goes down? So that usually means that whatever levels of demand is there is not sufficient to keep the prices, in a more normalized low volatility type of action. Whereas maybe in Alaska, every time the price goes down, there is an attempt to support the price, there is an attempt to rally, and so on and so forth. So that's how this visual interpretation of volatility is going to be created. So I totally agree with you guys. For those of you who said that Alaska is the lowest volatility before the next move up, and this is what we would be looking for, because if supply is so low and demand is present to support the stock, what kind of move are we going to have here with that low supply? Most likely the best move. Now, what is happening with Southwest? Even though we went down right here, look at how volatility starts to contract going into the apex. So we're seeing the volume signature contracting, and we're seeing also a price signature contracting and condensing into the apex formation. And that happens also if you took the whole range. That happens in a slightly above of 1/2 for the range, which is a really good positive sign. And we kind of seeing it here as well. And I understand for those of you who said that maybe JetBlue also has a lower volatility going into the apex, you are absolutely correct as well. But that again, all of the down moves that we have here compared, let's say, to Alaska, or compared to the latest moves in Southwest, are not going to be as low volatility events as, let's say, this last move right here in Alaska, and specifically in the United. And therefore, talking about the result of that low volatility, look at what's happening. We are definitely having the leadership very well defined on the next swing to the upside in both Alaska Group and Southwest. And then the next move for the United and for JetBlue are not that impressive. We are basically barely, and I should be using here 2012 as the point of reference. So we are barely coming above the 2012 highs here for United. We are doing the same thing here with JetBlue. We are slightly committing and almost trying to come back to the trading range. Whereas look what's happening with Alaska. We are traveling up in a very significant way. And also for United, we are traveling up in a very significant way. Now, you might not see this in a big way here, but let's look at 2013 range right here. And we kind of went through that before, so I might as well just show you that. Actually, let me do this. I think it would be easier. Okay, so next time, just want to make a mental note right here. Where do we see out of these 4 stocks in 2013 a low volatility stock? Which one seems to you that it has maybe a low volatility? And again, you kind of have to think in terms of where the price consolidates, relative to the rally, right? Then you have to think in terms of all of these reactions, where volatility to the downside is happening. And we probably, wow, this is really good. All of you are saying it's in Southwest. Yes. So again, relative to the rally, where we are, consolidating, where are we consolidating? Where are we consolidating here? And here, where are we consolidating relative to this rally? So we are seeing that if this is the size of the rally, we are in such upper part of that rally. There is no push to the downside in Southwest. Whereas in the JetBlue, let's say, We are definitely, touching one half of that rally, if not more. We are touching one half of the rally in the United. So that suggests that there is more selling that is happening on the reactions in these two stocks, and there is also inability, to push the price in the leadership type of manner. Alaska is showing that leadership on the way up, but it also shows a little bit more of the underperformance relative to the Southwest, and it shows more of the lack of that low volatility environment than the Southwest. We also could look at the specific, spreads or how the reactions are developing, and at some instances you are going to see some kind of decrease in the low volatility, like we're observing right here. But you have to take this picture also, in the context of this whole formation and identify what could be the most potential low volatility scenario. So let's see what has happened after this. And we're seeing how the new leadership is emerging after this area right here. So prior leadership and in combination with lower volatility brings us and such an outstanding result. And look at all other stocks, how they travel after this 2013 low right here. We're having a rally, but it's not very good rally compared to the Southwest. And look into this area right here. If we would be thinking that our point of exit was, the beginning of 2015, let's say somewhere here, or I would rather even say like, mid of 2015. So somewhere here, what do we have in terms of, let's say, if it would be a short-term buy and hold, so to say, right? So if we're buying here in 2013, we would be going through this reaction. We would be going through this change of character and through this consolidation. Is this a good trade for us? Not at all. And then in 2013, JetBlue is taking off, but then again, we kind of having the next consolidation here that is touching the previous resistance, and only after that we're seeing some kind of acceleration. And actually, I'm wrong here. I'm sorry. I apologize. So 2013. Yeah, this is 2013, right? The end of 2013. Yeah, so yeah, I'm discussing the right thing. Okay, and then we were saying, okay, the exit, let's say mid of 2014, not 2013. So I did it incorrectly for United. But you guys see my point here. I mean, the way how we travel is so much different than this. There is nothing that could be compared to this type of traveling of the price. Even Alaska is having its own moments where, in 2013, it has this reaction and then some other reactions, and maybe, more complex reaction than this one right here. So volatility is such a big thing, and we started with this idea when we were discussing the markets, and we said that volatility actually could even predict for us the directional bias and the definition of the trend. How cool is that? We could define the bias based on the structure. We could define the bias based on just, volume analysis. We could define the directional the direction based on the supply ideas, on this volatility ideas. Guys, let me pick up this package. I think it's the UPS, and let's just have like a 1 minute break right now. So I'll be back in a second. I apologize for this. All right. All of those Christmas presents, you know, you have to make sure that you're picking them up, otherwise you have to go to the center, which I kind of don't like. So thank you guys. Some comments here. Is that a signature of less supply or more demand, or both? Is that institutions rotating into or out of a stock? So where exactly? Is this on this slide or a different slide? Okay, so no answer there. All right, I guess we're gonna go from this. Maybe we'll talk about this during the Q&A. All right, so again, a very interesting idea about the volatility and how it decreases or how it increases in the distribution. And I think that it's slightly underrated as a filtering tool. And I actually, where did I put it? I guess not. But if I would rename these slides, I would just say that I want to use this, and this was in the outline, so yes, decreased volatility as a filtering tool. I guess I want to make it a little bit more of the emphasis in the next cycles for the practicum and for advanced Wyckoff course, because it's a very important idea, and I'm just emphasizing it today because for, as you can see from all of the examples that we went through, there is the idea of the decreased volatility is not only relevant to swing trading, it kind of is important in the determination of how the price is going to move. And again, we're not interested that much in the directional buys because that seems to be an easy task for us. We are more challenged by the selection itself. Which stocks are going to pick up, you know, when the market's going to advance. We know that the stocks are going to advance because the market is showing that it's going to go up. We are more challenged by the idea of narrowing down to the stock that is going to outperform in a specific way. And we want to reproduce this practice over and over and over in our trading. So obviously, the ideas that we've discussed about trading a stock as a part of the leading industry group is extremely important, and understanding the rotational scenario between those peers is extremely important. This low volatility idea is extremely important for the character of the next move. And everything else is kind of like important but somewhat secondary. If the market is going up and you're going to pick up the stock that's going to go up, most likely it's going to have already, you know, a structure there. And, you know, you probably going to make fewer mistakes on the structure just because we're talking about the structure so much and because this is such a basic concept, then let's say some mistakes on the volatility or on the leadership rotation within the industry group. So those are a little bit more advanced ideas, you know, and you would have to pay a little bit more attention to that. But I'm glad that we are definitely talking about that. All right, so let's talk about trading tactics or trade management. Specifically, let's start with point of entries. So looking at this chart, how would we identify our potential points of entry? And I'm looking at the time. We're having like around maybe 45 minutes that we can allow to go through the material. And then I really would like to go through some Q&A, and maybe we'll go a little bit beyond 4:30. So I'm just trying to see how quickly we can go. So I'm thinking that maybe this is the time when we could invite some of the attendees to actually interact with me. So and this could be a good exercise for us to do this. So for those of you who have sent me an release form, if you want to volunteer right now for this particular exercise right here, we just want to identify those phases, please say yes or unmute, and then I'll unmute you and we could have a conversation. It will be good also for my voice. I'm feeling like, I'm almost about to lose it. Okay, Aaron, how are you doing?
Can you hear me?
Yes, I could definitely hear you a little bit on the background, but yeah, go ahead. So one of the things here that we want to do is we want to go through the phase analysis, and we want to go through the Wyckoff points analysis. So right away, let's say that we are in 2012, somewhere here, and this is the place that we were identifying as the time when we would be looking at some stocks in this leading industry group. So let's analyze everything what comes before. So how would we do that? What catches your eye before this point right here?
We have down movement in the stock, and in July 2008 we see a big reaction. But before that, we see another reaction, which is quite of similar size. But comparing the previous one is the first one, which is the largest compared to previous rallies.
So
But one, which we numbered one, we see that price acts in between these two highs and lows. Therefore, I think it will be most appropriate to say that we have selling climax in point one.
Okay.
And automatic rally just at the top of this swing.
Okay. And then what comes after that right away?
Secondary test.
Secondary test, phase.
A.
Phase A.
We can draw out and resistance lines as well.
Awesome, awesome. Okay, so let me kind of like rephrase what Aaron was saying. And I definitely enjoyed listening to him, talking about this two moves up, because this move up right here, it definitely looks a little bit like an automatic rally. And I would be inclined, even at that point, to put the boundaries of the range maybe somewhere here. Now, would I be looking at this stock at this point of time for my upswing positions? Unlikely, right? How would this stock come up to us? In what type of screen? Unlikely, unless we are trading the stock, to the downside. Then I would be thinking that, okay, this could be an automatic rally, and this could be a secondary test. So my exit points could be around this area right here. So this rally right here is definitely much larger. So therefore, compared to all of the rallies before, we're definitely seeing that this was a change of character as an automatic rally with the secondary test and climactic action that comes in between. So phase A is well identified. How would we go about our analysis further, Aaron? What's catching your eye after that?
We have upthrust action. And probably we have very long phase B.
Okay. So we have a test here.
Upthrust. Yeah, secondary test. we see that we see higher lows,
Mm-hmm.
and then after another upthrust.
Okay. So what does that suggest, by the way? We are in phase B, and I kind of mentioned this idea a couple of times today. With the higher lows, how phase B develops, and with the upthrust action, so we are having some higher highs on the way up. What could we expect from a potential phase C? So this picture right here, what kind of phase C could we expect? Could we
We can
expect a lower low or a higher low?
higher low phase C, which I assume will be stronger than the market if we perform relative comparative analysis.
Well, I don't necessarily know whether we're going to be stronger in phase C, but we definitely could say that structurally, as you mentioned, that we are most likely, there is a high probability that we might have a higher low, so therefore we might have an LPS. Why is this important? Well, guys, think about this. If we know that it's going to be, a high probability for the higher low, then our expectation for the spring is going to be very almost non-existent, and we would be expecting some kind of reversal slightly above the support area. So that could give us a much better point of entry around phase C than when we would be expecting some kind of sprint situation. Okay, great. So, and I kind of, sorry, I kind of put already phase C here. Okay. Um, okay, well, let's do this. What about, I want to talk about this. So if this is phase C, then a sign of strength is where? This whole thing?
Sign of strength up in 2013.
Yes. So here is our major sign of strength, and here is our backing up action right here.
Yeah,
Okay.
right before I label like a minor sign of strength.
Okay. So in a lot of instances, there is some kind of misinterpretation on the labeling based on the original, let's say, climactic action, automatic rally, secondary test, phase A. Then someone could say this is a test in B, this is an upthrust in B, and this is our C. So looking at this type of labeling, which is obviously incorrect, and assuming that this rally is a sign of strength rally, could you quickly compare this rally, number one, to this rally, number two? And what would be the differences between these two rallies that would give us an understanding that indeed the second rally is our sign of strength rather than the first one?
The difference between these two rallies is commitment above resistance level and progression of clauses of
Yeah,
trust.
I like that. Yes. So we have the commitment, and then we're seeing that the price is trying to move up, even though it's in consolidation, but there is a constant attempt to push the price up. Okay, and we don't see this here. Here we're seeing an upthrust and then coming back into the range. What else? Maybe in the character of the rally itself.
Yes, the first rally is more volatile. We have number of cases when we have reactions to the downside, and with second rally we see less cases of reactions and actually smaller reactions.
Absolutely. So for the sign of strength, we have to see that the supply has been absorbed or being absorbed on the way up in phase D. And this is what we're observing here. I mean, look at the multiple reactions that we have here on the way up. Is this the way how the sign of strength should behave? No. And even though we have multiple reactions here, they are more subdued, they are more controlled by the big hands, and volatility here in terms of both the volume and how the price moves to the downside is actually much more manageable than in the first case. All right, really good. Aram, thank you so much.
Thank you too.
I'm gonna mute you. Okay, so and here is our trading range, and I put all of the labeling right here. And one of the things about the entries is you kind of have to just know what the entries are, for each phase. So one of the things that I want you to do is just to print out this chart. We've talked about this in the advanced and the practicum, but still it's a really good reference point for us to know and to understand all of the possible entries. So like in phase C, where is our point of entry? Sprint number 3, which is going to be low spread, low volume. So that's how we would identify. I probably would have to put another column here, how to identify. That would be most useful. Then the test of sprint number 2, or the shakeout, last point of support if we are failing, like right here, to produce a sprint. And those are going to be our 3 major points of entry for phase C. We would be, and I'm actually putting the actual entries right here. So how would we buy a sprint number 3? At the close of the bar, returning to the trading range. Test number 2, the reversal of the test in the downswing. And then last point of support, just a reversal of the downswing of that last point of support reaction. Phase D, we could buy a sign of strength bar on a sign of strength rally. We can do this as a breakout trade or at the close. Both are valid possibilities. Last point of support, just the reversal, backing up action, a reversal, or if we are, if this is a simple backing up action, just a reversal. But if we're having some kind of more complex structure, then we would have to go through this whole analysis of the structure and identify, potential phase C. Phase E, any type of breakouts out of the backing up action. So let's say a breakout like this after the backing up action is completely appropriate for us to buy. And some kind of stepping stone trading ranges, so something like even this acts as a stepping stone, so phase C, D would be the ones that we would be looking for. How would we use the stop losses? So with the stop losses, and we just finished this material with advanced Wyckoff course, it's definitely the idea of the commitment and the number of support levels that we want to observe away from where the price commits to the upside. And what do I mean by that? So if there is some kind of consolidation and there is a commitment, we want to seek 2 support levels away where we're going to commit our stop losses. So if this acts as the first support level away, then maybe this level or this level could act as the second point of support. Next commitment, and we kind of would be still staying here. And again, for a swing trader, this is not going to be, for a short-term swing trader, this is not going to be as relevant, but you're still going to be using those type of commitments based on the significant bars. So for instance, let's say that this is not a weekly and this is daily. How would we move the stop loss in this area? Let's say if we are having a point of entry right here, then the next movement of our stop loss is going to be this bar, this bar, this bar. So any type of significant bars or combination of bars that we're going to convert into the significant bar. And every time the price commits to the upside, this is where we're going to be very active in our movement of the stop loss. And then right here, here is our exit. So here's the trade. Here's the point of entry, and here's how we move the stop loss, and here is our exit. The same here. let's say that we've entered somewhere here for whatever reason. Let's not discuss this right now. Maybe this is not a good entry. I'm just looking at the movement of the stop loss. So here it is. Here it is. And you can even use an attempt as an up thrust to go up, and then this could be an exit. So here we go. And the idea here, obviously, is to be somewhat conservative with your stop loss at the beginning of the move when you open the position, and somewhat aggressive when you want to get out. Why would aggressive stand at the end of the trade be much better? Well, at the end of the trade, we usually is going to experience some kind of acceleration to the upside, which is going to dictate to us that there is some kind of climactic action that is happening. And therefore, after that, we might expect a consolidation and even a reversal. So any type of much more aggressive exits, and in this case, for this bar, we could use just 1/2 of the bar. That would be an appropriate exit as well. So we are actually exiting much faster than here, which is, again, comes to the idea of how efficient we are with our equity, with our money. We're probably not going to be as successful here on the idea of the climactic action because it's not well defined. But combining the bars and exiting on this reaction, I think, considering the length of the trade, is actually quite efficient. Okay. And again, I'm kind of going through the mechanics here of how to go about your exit points and stop loss movement. One of the most simplistic ideas is just to use conventional technical analysis tools. So something like trend lines, where you're raising your stop loss along the line of least resistance, and you're allowing yourself or you're allowing the price to travel as much as possible until it actually closes below this trend line. The trend line that I'm using here is more of the reverse use of trend line, where I'm taking the highs, creating the line of resistance, and then projecting that from the low. And we could see how here we're not necessarily having the close below the trend line, but we definitely have multiple closes in this area. So in terms of the exit, that kind of shows us the same exit criteria as with the significant bars. Moving averages for your swing trade definition also could be quite successful. Early in my teaching career, I actually was teaching how to use the moving averages for identification of the change of character, identification of the market environment, and we're seeing how here your short-term trade, which you are originated right here, could have even some add-ons closer to the moving average, where the price touches the moving average, and then exit is just going to be a close below it. So once you define the moving average that is reflecting the movement of the price close enough, you're usually going to do a lot of great things on the exit just based on that alone. And you can use the moving averages in any of the time frames. You can use it on the intraday, you can use it on the monthly. In this case, we're using this on the weekly. And we went through the significant bars, where we just moving the stop loss based on the bars that are quite significant, where the progression to the upside is and commitment to the upside is significant. And I'm just showing this in arrows, how we would be moving the stop loss based on that idea, and how we would be exiting. All right. So now let's talk about this. Let's talk about this switch technique. Before that, there is a question here. We should expect testing after a close of significant bar and therefore some kind of reaction. Isn't it better to enter after that testing? That's an interesting idea. right? So we are talking about, let's say, some significant bar, and maybe it's more evident like in this scenario right here, or maybe in this scenario right here, this scenario right here, this scenario. So look at how many instances we have significant bar which is being followed by the test. And this is actually something that we've discussed a lot during the Wyckoff practicum by studying the moves that are either create some kind of volume spike, some momentum, and what comes next. So the testing after that is extremely crucial for us to understand what kind of tests we are having here and where this type of testing is going to fail. So you can use that as well. And as you kind of can see right now, I'm showing you so many different tools on just this, idea of the movement of the stop losses. So it doesn't really matter what stop loss you're going to use. In a bigger scheme of things, the moving average is going to take you out at the appropriate time. The trend lines are going to take you out at the appropriate time. The significant bars are going to take you out at the appropriate time, or whatever other trend following tools you're using to move your stop loss, most likely they will allow you to stay in the trend for quite some time, and they will take out, quite considerable chunk of that trend. Now, let's come back to the idea of testing. Would it be better to enter after the test? Yes, that's a great idea, under specific conditions though. As our entry is here, we are definitely not coming into the position that late anymore, right? So therefore, that might be irrelevant if we're just opening a position and closing a position right here. But it could be relevant if we don't have a position at this time. And therefore, maybe after, a big acceleration, we are having some kind of testing. And the entry on the test could be quite appropriate if you go to a lower time frame. And in some instances where we're going to have a momentum move, we might not experience that. Or we might experience in the test as an upsloping structure, like right here. So therefore, you have to be cognizant as to where exactly those type of momentum moves happen for us to go into the test. And you also have to be a little bit cognizant as to the duration of that test, right? So if I'm entering, let's say, somewhere here, I would probably have to wait for a good 3 to 4 weeks in this case for the price to start moving in a much accelerated manner. The same happens here after this test, right? So look at this test in action. So if I'm entering almost right away, that's going to be a little bit hard. Even if I'm entering in this area right here, that might be also, take a little bit more time. Our preferences, if we're swing trading a much shorter period of time, is just to take this, 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 and this. Why are we targeting this specific moves? Well, because this is where acceleration happens. This is where momentum happens. So whatever supply is coming in on the test, it has to go through the period of absorption. And then after that, there's going to be a period of price acceleration. So therefore, you want to catch this period here. You don't necessarily want to catch the absorption. So that's the only thing that I would be concerned about around that idea, which is extremely logical and has a merit, behind it. So really good thought there. Okay, so let's talk about the switch technique. The main idea here behind the switch is that you want to create if you are analyzing the stock and you came to the conclusion that this stock is going to be the stock that's going to outperform the market and it's going to outperform the peers, one of the ideas is to maximize the profit as much as possible. I always refer to a trade that George Soros described out of his career, and that was the trade of the British pound in 1992, I believe. And he made $1 billion on that particular trade, and obviously, I mean, he had a big size there. And he has committed, if I remember correctly, 4% of his equity to that particular trade. And when the trade was done, and he had maybe years to reflect on that trade, and reflect on that trade just because of how famous this trade has become, and it kind of put him on the map in a big way in the trading community. Obviously, he was known before. But I think that after the reflection, he wrote that I should have put more and exposed myself more in that situation, because it was quite evident of what's going to happen, at least to me, and I had a very high conviction. And that was one of those trades that maybe are happening like once in 5-10 years. So again, we're coming to the conversation about the opportunity. Opportunities are abound in the markets if we are going through a lot of instruments. But opportunities like, let's say, something like of a Brexit crash, or 2007-2008 crash, or a structural crash of 2000 through 2002, or reaction to Trump's win in the U.S. election. Those opportunities are going to be very unique opportunities, and they are not going to come very often. So you have to understand how you're going to leverage on that and produce the most possible outcome for your equity line. So therefore, the idea here is, if you feel confident about your analysis in the trade you're about to perform, maybe there are some ways where you could leverage that to a higher degree. And one of these leveraging techniques is what I call a switch technique. And it's an idea of opening a position on a lower time frame. So for instance, if you're looking at the daily structure or a weekly structure, you would want to go to the intraday point of entry, and you would want to go to the daily point of entry, respectively. And at the same time, once you've entered on those lower time frames, I want you to convert one time frame higher than the time frame of your analysis. So for instance, if you were analyzing the stock on the daily time frame and you've entered on the intraday time frame, your exit, if you're correct in the trend definition and in the up movement of the stock, is going to be on the weekly. So what that creates is, on the intraday, you're creating a situation where the difference between your point of entry, let's say you're entering somewhere here, and you're looking at the daily, and you're identifying phase C, and during, let's say, these days right here, you're creating the point of entry that is the difference between the point of entry and the stop loss is so minimal. So this minimal risk, where risk is going down, is going to increase your size of the position. If you're increasing the size of that position and you're not exiting on the first sign of changes of character, which just basically constitute that the trend is going to continue, but there's going to be some kind of consolidation. And instead, you're holding through this whole trend, and you're exiting maybe on the weekly chart here in the weekly might show this spread right here as the spread that is overcoming, you know, the less significant bar move. You are basically on the increased size having a substantial profit. So it's as if you would be saying that, let's say, if I'm opening at 35 and I'm not exiting, let's say, at 40, this size right here, if I would be entering here and my stop loss is going to be here, and let's say I'm trading just 100 shares, and I'm entering at $35. And my target is going to be, or my exit is going to be at 40. So I'm basically making a $500 profit, right? Am I correct? Yes, I think so. If I'm creating a different size based on the switch technique where I'm going to the intraday level and I'm having some characteristics where I'm saying by the end of the day, I'm going to keep this position, and not only am I going to not exit at 40, I'm going to try and continue or stay in this position until I'm actually done with this trend at maybe around 60. So the trade is about $35 to $60, and the size that we have, the original size, because of the contraction, might be more. So here I'm seeing maybe like 1, 2, 3 units of risk, you know, based on this stop loss. So I'm going to say that instead of 100 shares, I have 300 shares. And instead of $40 exit, I'm exiting at 60. So that's going to bring a different math. For the $25 of profit, we're going to benefit, and let me just quickly calculate this. I can't even think straight here. So $25 dollars in profit times 300. That's going to be 7,500 in profit compared to only 500. Granted, we can originate a trade right here, and we can originate a trade right here. But in some of the instances, we still going to lose some of the profit in these areas between the exit and the entry. And our size is still going to be relatively lower to the size for our intraday entries. So therefore, we might have $500 times maybe 3, which will lead us to about $1,500. But still, we can't really match any type of profitability that we are having with the switch method here. So let's look at this a little bit more. And specifically, I'm looking at Monster beverages here out of the trading range that we've looked before. And I want to go, and once we are going into the potential phase C, what I'm going to do is I'm going to start intraday trading this stock. And I'm going to start thinking about how could I actually find the points of entry for this stock on the intraday level, and then switch on the daily exit and exit, you know, as the daily trend changes behavior. So what I would do is I would go to intraday picture and go day by day and try to figure out where possibly I could have an intraday entry and where I could possibly switch to the daily time frame and possibly even to the weekly. So on the first day, a lot of supply that requires the testing. So I don't want to come in on day number 1. Second day, there is some kind of testing here, but there is no entry signal after the first 30 minutes of trading. And this is one of the requirements that I have for the day trading technique that I have for stocks. This is something, again, that I'll discuss more in March. So for those of you who are interested, you know, either in this technique or maybe just intraday trading overall, you know, March workshop would be, you know, the place to be and to talk about this. So specifically, no entries in the first 30 minutes. Then the next day, so no day one, no day two. The day number 3 starts with a lot of supply, and if we thought that this could be a secondary test, it's not, because it's a low. So again, we have to have some kind of test in action. We don't necessarily have the entry here, and we still need to test this low right here. And going from day to day to day to day, we're probably seeing a potential point of entry either right here, or we're seeing a point of entry in this day. And by the end of the day, we're seeing how this creates a big spread day. And because we've entered this somewhere either here or here, what it's going to do is going to create a much larger position size for us than the original position size. So the original position size and the risk was, let's say, I'm sorry, $2 between the stop loss and the point of entry. But here our point of entry and stop loss on the intraday basis are so low, only 30 cents instead of $2. So what does it mean? If the average exit is $40, I'm sorry, then the average profit is going to be $12.35. We're having an astronomical average risk to reward ratio. So on a single unit of risk, which is 30 cents, we are making quite a considerable number of units of profit. We are making 41 units of profit on a 30 cent stop loss. So I'm giving you this technique just because I use it myself, and I think that there is a value here. But I also want to warn you, this is a very dangerous technique. So, and I only give that to students already in a more advanced, with the more advanced understanding as to how you could use this, and how you could damage your equity line in a very quick, big way. Imagine if we've entered the position on this day and we closed quite profitably, but then there is some kind of event where there is a gap to the downside and we actually open in next day with the gap down. What is your risk here? All of it. So instead of this risk, you are multiplying your risk by a huge number here. So you have to be having such a strong conviction that this is the place where we're gonna start moving to the upside in a more meaningful way. And you have to be so precise with your timing that, again, I'm just disclosing this to you guys because this is something that we mentioned already. I mentioned this during the advanced Wyckoff course, and I just kind of wanted to continue on the theme. So just read this, contemplate about whether it's for you or not. 99% of the traders should not be using this technique. But again, I just want you to be aware, and maybe you can make some kind of adjustments for this technique with other instruments. What would be so less riskier, right? So maybe an options trading, which could be also on the intraday, which is totally possible. You could create an option trade right here, considering your risk, and if the price goes down, you can close that with your regular risk, let's say 1%. But then if the options are working out nicely, then your size for the option position could be increased. And therefore, even if you are going to have some kind of gap to the downside, your risk still stays at 1%, yet the number of option contracts that you're purchasing based on the entry and this possible intraday stop loss is going to drastically increase, and that's going to increase your position size and your profitability. Okay. All right, some questions about this description. let's just leave it for now. I don't want to go into a lot of details for this because in the majority of cases you guys are not going to use this technique. And plus, I kind of want you to know but not necessarily do. So just read this, go through the definitions here, and then, if you have the questions, just come back to me. So it's all self-explanatory here. Okay, exit points. So exit points, and we kind of discussed that. We've discussed the stop loss movement, right? And that obviously is going to be related also to your exit points. And we kind of said that you can use significant bars, you can use trend lines, you can use moving averages, you can use any trend following techniques. One of the exit points just based on Wyckoff methodology is a change of character, and a change of character that's going to occur in phase A. So therefore, identification of the specific Wyckoff events around phase A are crucial to us to understand that the trend is done and we should exit our position. So what are the exit points here in phase A? Well, obviously, just by the stop loss, the ones that you're going to use either with significant bars or any other techniques. Evidence of the climactic action where the spread velocity and volume increases, so something like this. Change of character. And we know how change of character acts. We want to have the largest reaction in the trend that has been established and it has been going up for some time. So we could see this quite visible, this change of character is. And also we are seeing that a break of the trend is happening actually on the change of character bar, which is the biggest bar right here. Supply is coming in, confirming that this indeed is a valid break of the trend and is a valid change of character. And then the next point of exit for us is going to be on the way up on this secondary test. So this exit here I've created just for the purposes of exiting at a better price. You always have to think about the efficiency here of this exit, because if you are on the weekly time frame and you were able, let's say, to stay in the trend for quite some time, and go for, let's say, 2 years, then maybe another year or 6 months is not going to be such a big deal. But for us who are swing traders, that's going to amount to a lot of inefficiencies in our swing trading. So therefore, it might be appropriate on a smaller time frame where you have a trading range starting to develop, this change of character, and then you want to exit on the secondary test. But I want you to kind of caution that maybe the best exit is still going to be somewhat close to the original break of the trend. And your efficiency, even with slightly lower prices, are still going to be somewhat better than just staying through this whole low of the automatic reaction, where potentially you can be emotionally forced to close the position just because of how the price travels to the downside, and you don't want to give up so much profits. I mean, look at this. You're going from about 45 to 30. So that's a quite considerable decline right there. And plus, again, the time that it's going to take to get back to this price level is just going to be, just too much. Okay. All right. So we are at 4:20, and we're going to do this. So the exercise that I have here is on sketches, and this is the exercise where we are discussing, the trading range that we had here. We are discussing what the peers are doing. We are discussing also the long-term structure and the trend. We are discussing the comparative analysis right here and the volume analysis as well. And you have to make a determination as to is this a good time for the stock to for us to take the position in this stock based on all of those characteristics. And then once you, it's kind of like a feedback loop where you go to the next chart and you see what action has happened, and you go and analyze again in the same manner. So what I want you to do is I want you to get the extra value from this workshop and just basically go through this exercise. It's probably going to take you maybe an hour to do that. And at the end of the slide deck that I'm going to place on our website tomorrow, guys, I just feel a little bit exhausted right now, as you could probably sense from my talk now. I'll do this tomorrow. I'll put all of the videos tomorrow, and I'll put the slides on the website tomorrow as well. I'm going to give you the solutions to that exercise, to this exercise as well, for each of the steps. So what you have to do really is you have to be disciplined and not go forward, not to see all of the slides and what has happened, and just go step by step. And then once you're done with this whole exercise, go to the solutions and just, check what you've done and check, how I was describing all of those trades and, analytical points. All right, at this point of time, I think what we're going to do is we're going to go to the Q&A. Well, let me just get to the right slide. I intentionally okay. Actually, it doesn't matter. Why am I doing this? I think I'm mentally just a little bit tired, so that's why. Okay, do you see my screen again? And let's just, guys, could you see my screen again? Yes? Is the screen showing? Okay. For some reason doesn't. Okay, let me just see. Yes. Yeah. Yes, southwest on the screen. Yes. Okay, great. So let's just go through some Q&As. All right. So obviously a lot of material that I gave you today. Some of it was new, some of it was a repeat. So hopefully, for those of you who are new to this material, you'll have an opportunity to go through the slides again, and in a way that you will start understanding this a little bit better. And for those of you who obviously went through some of my courses, a lot of the stuff should be very clear, and there are some very important items that we've covered today that we not necessarily talked during the classes, or if we talked, that was just, like on the surface. So hopefully those were great discussions for you. All right, so let's see what kind of questions we have. First question. Visual quantitative definition of change of character for an accumulation or distribution in the market. Is this the largest rally reaction compared to long-term, intermediate, and short-term trends respectively? Yes. So the idea about the change of character is always going to be about changes in how the price moves, or how the volume also reflects that. I don't have the volume signature right here, but you kind of you can definitely do that as well. You can incorporate the volume signature, and maybe at some point down the line I'll do that, and I'll just put this into the content as well. So what's the main idea here? Just to repeat, we want to see the change of environment going from one trend into another, and therefore the idea of the price and volume volatility is going to be extremely crucial. We're seeing how in the downtrend volatility is decreasing during the range, and that suggests some kind of possible reversal, We need a confirmation by the rally that's going to outperform everything that we've seen before in the trading range, and even outperform on the absolute basis, those reactions that we have to the downside. And then as the final confirmation, we want to have a change of character and more substantial reaction, which still going to allow us to judge volatility as the decrease in volatility, and obviously a continuation of that trend. And those are basically defining for us the spots where we're either saying that the trend is changing, whether where we are establishing our first initial positions, for the longer term trend, and where after the confirmation we could become extremely aggressive with all of our trades in one of the directions. And if you think about this, you might be thinking, well, why not trade here? And we kind of discussed that we still could trade any of the rallies if we understand how to trade those, right? Even within the trading range and even within the bear market definition environment. But so some of the trades are going to be available to us as swing traders. But the main idea is, how do we trade up rallies predominantly, right? In what way? We might be trading these rallies, which again, for the beginners and intermediate traders, I would not advise. But if we're trading, we might be trading less aggressively on this rally. If we are short-term swing trader, and we are going to be trading more aggressively after that in all of the other instances. So when you look of this from the perspective of the long-term trend, since 2009, from March to about, let's say, July. So how many months is that? March, April, May, June, July, 5 months. And then with where we are in the long-term secular trend in 2016 in December, we are still in the uptrend. So all of this time after July of 2009, we should be extremely aggressive in our swing trading to the upside in any type of the scenarios. Even in the scenarios where the change of character might reflect some bearish sentiment, we're still going to observe how volatility contracts, being confirmed by the volatility to the upside, and we still want to be extremely aggressive even in those type of the scenarios. So for what, 6.5 years, 7 years, we will be swing trading aggressively just based on this change of character right here for the last down move that we have had. And that's quite a considerable, and I'm going to put here 7 years, quite a considerable accomplishment, considering that, you're giving yourself a chance, to be biased in one direction for the secular trend, and then you're just using smaller market reactions, to define those additional points of entry, to be more aggressive, during those, and so on and so forth. So I think that to wait for the confirmation for 5 months and during which you still can trade is quite remarkable. And the same for the definitions to the downside. All right, great. Next question. Earlier slide you mentioned that a secondary test can't go below price that is being tested. Does that mean for every spring we should expect a secondary test of every spring? I think I understand the question correctly. So let's say that we are in some kind of spring situation, like right here. So could we have the test or shouldn't we have the test? And that comes to probably that slide where I'm talking about the points of entry. And we're talking about that for spring number 3, which basically is this. The price goes down, comes back almost instantly. So for this type of spring, we could buy right away as the price comes back into the trading range. And usually this spring is going to be associated with low volatility. Now, the sprint that actually spends some time below the support should be bought slightly differently. We should wait for the test because the supply is coming in, so we want to check that supply. We don't want to be in a situation where this sprint is going to become a sign of weakness. So therefore, we might be waiting for some kind of supply contraction for a higher low and a testing action. So only the sprints number 3 with low volatility could be bought right away, and they don't necessarily going to have secondary test. And other type of sprints potentially might have the test more times than not, and you usually want to buy that test. Next question, how many time frames to use for analysis and trade purposes, and how to decide what type of action to do on each time frame? I think that question is actually also is for Monday Q&A session, right? But let's address this here. So again, you definitely need to understand what time frame you're using for your analysis. I've introduced also a little bit more of the advanced idea about how the time frame should not be static in your trading if you want to be more universal in your trading. And you should think about the opportunities in multiple time frames, specifically based on the idea of the market environment. So your trades here are going to be different than your trades here because of how market behaves in these two environments. Now, having said that, my preference usually is going to be looking first at the weekly if I'm looking at the stocks, and then going to the daily, and then going to the intraday if necessary for the points of entry. In my trading of the S&P, my primary time frame is going to be to start with the daily because I know the weekly structure. I mean, I don't have to repeat it. And I'm looking for the daily only for the definition of the last swing because I already know exactly what has happened before. I've analyzed it each day. I know the structure. And then go to the lower time frame for structure definition. Let's say I might put the 60 minutes for the structure and then maybe 5 minutes for the entry. So it just depends. It depends on what time frame you predominantly trade. You know, whether you're trading, you know, specific instruments with stocks, you definitely want to go into the long-term picture first and then scale down. But if you're trading just one instrument and you're consistent with that instrument, you're gonna know your long-term picture really well. There is no need to go to the long-term pictures. So just smaller time frames. All right, next question. Are all swings started or finished by reversal bars? And are all the reversal bars change of characters bars? They are not, the reversal bar is not going to be necessarily the first bar for the reversal. We could have some kind of bar that's going to define maybe is still an element of a consolidation. So for instance, maybe, and let me just pull out maybe a better picture, like this is more visible here. So let's say that we are somewhere here. So here is the reversal bar to the last significant bar that we had on the upside right here. But look at how many bars do we have in between. Right? And even as the high is here, this is not the reversal bar. So it doesn't necessarily, it's going to come first as the potential reversal right away. This situation right here, we have the last attempt to commit to the downside. So this bar is going to be our reversal. You can use it like this, or you might be using this as the last significant bar to the downside. Okay, guys, I'm sorry. Ooh, screen is not changing. Okay, how about now? Do you guys see the screen? It should be 2008, 2009 range. Okay, I apologize for that. Kind of froze here, with the screen. Okay, no worries. Okay, so I was talking about this bar right here. This is a reversal bar relative to the less significant bar to the upside that we have. But look how many bars we have in between. And even though the high was right here, the next bar is not necessarily a reversal bar. So it's not necessary for the price to reverse almost instantly after making the new low or the new high. In this instance right here in March, this is the lowest point of the swing, but we are not reversing on the next bar, and we're reversing on the bar after that. So it might take some time, but in some instances the reversal is going to be extremely obvious, extremely quick. So for instance, this reversal right here, it happens almost right away if you're looking at 1/2 of the spread here as a reversal. Let's say this reversal is relatively quick. There is only one bar in between. But again, it's not a requirement that the reversal bar is going to come right away. All reversal bars changes of character bars. Predominantly that's the case, right? So change of character bar for this move to the upside. Change of character bar for this move to the upside, change of character bar for this move to the upside, change of character bar for this move to the upside. So predominantly, yes, they will be changes of character. But in some instances, a change of character bar might come a little bit later on. And I'll try to find you an example of this. And it's usually going to happen a little bit more about, I would say, top informations. Okay, I'll have to find an example of that, but predominantly the reversal bars are going to be the change of character bars for that particular swing. But it's not necessary that a change of character bar for a particular swing is going to be a reversal bar for a much larger move. And I think that that's kind of like obvious and evident. So for instance, right here on this move to the upside, we might have quite a lot of change of character bars. All of those are change of character bars, the ones that I'm highlighting. But yet it doesn't ruin the whole overall much larger trend. So you have to think about that as well. Okay, next question. Okay, I'm going to come back to this comment later on, and we're going to probably finish with this. But next question: how frequently we should update our watch list for short, long-term swing trading? Because swing trading is relatively short in the duration, right? So it's not a buy and hold strategy. Then that necessitates us looking at the swing candidates quite often. So my preference would be to look at the selection process each week. So for instance, Friday, Saturday, Sunday, Monday morning maybe, after the close on Monday, you could go through your selection algorithm and extract the stocks for your watch list, which you will be following only once a day. There is no reason for us to stay in front of the screen, even for swing trading, unless this is a very short-term swing trading, and we're swing trading like from a day to 3 days, from a day to like a week. Then you have to be more on hands with this type of trading. But if our average holding period is, let's say, from about 3-4 weeks and up to multiple months, then a weekly analysis would be appropriate. And then once you are in the position, if you're moving the stop loss based on the daily, you just have to look at the stock just once a day. I usually would do this at the close of the day, around 12:30 to 1 o'clock my time, Pacific time, when the market is about to close, and just to see whether the stock is moving in the direction of the trade. If it does, should I move the stop loss? If it doesn't, then I just go away. And there is no reason for me to spend any more time. If it's a short-term swing trading, then you definitely will be conducting more analysis, more frequent analysis, and your watch list is going to reflect that in a sense of, let's say, having different candidates and for your swing trades, and the rotation is going to happen much, much faster. So for this type of swing trading, instead of actually going into such a big universe of stocks, I would actually probably, just pick specific universe of stocks so that my rotation on the watch list would be less, and that would require less time. So that would be my advice. Okay, last question, and then we'll go into the remark, and we're gonna close out this whole workshop. How long do industries lead? Are we talking industries also on the weekly? How long do industries lead? Well, if you think about the leadership of the industries, from the historical point of view, you will see that the industry groups are, and their leadership is usually going to be associated with the big institutional sponsorship of those industry groups and leadership stocks. So therefore, the intention behind those trades that institutions conduct are going to be all about business cycle or the cycle that is specific to the group or specific to a stock. And usually those are going to last for years and years. And again, as I said, they are going to be associated more with the business cycle. Now, for us swing traders, it's crucial to understand which group is leading and to understand that this leadership trend is not going to stop after 5 or 6 months. And that's kind of like a very interesting idea. And again, I think that a lot of people are discussing it from the point of fear, where the stock might reverse and continue to the downside. It could happen, but what is the probability of that after all of the supply has been absorbed by big institutions? Do you think that they're going to sell after 6 months? Unlikely. There is no reason for them to do this. They, in their models, the valuation of the stock or the whole group is probably much, much higher, and they understand that it's going to take time for the group as a whole to restructure its business, to improve the cash flow, and therefore it's going to take years to do that. For those of you who have their own businesses, you probably intuitively understand this idea because the change takes time, and we can't really in our businesses, be extremely fast. It just takes a little bit of time, to produce that type of change. For us as swing traders, again, I'm going to repeat this, the crucial understanding and awareness is about how long the trend like institutional trend is going to be unfolding, that it's not going to be stopped right away, and that the leadership is going to stay there for quite some time. So the leadership is going to consistent for a few years throughout the trend, and that's going to present us with opportunities for our swing trading. And we also need to understand that the leadership within the group is going to change from time to time and rotate from one candidate to another. All right, so that was the last question. Now the last remark, and then we're going to stop, guys. Roman, thank you so much for all your hard work and dedication. I'm realizing how much more I need to do. I'm realizing how much more I need to restudy and repeat this knowledge again and again. This workshop was amazingly helpful. Thank you, and talk to you on Monday. So I kind of want to echo this sentiment, and obviously thank you so much for such a great remark, such a great comment. I've enjoyed this workshop. I always enjoy kind of like those a one-day event. I have to unwind the next day and kind of like don't even look at the charts because it's just so much talking that I do and just going through all of these ideas and charts. But it's a unique experience for me as well, just to going through basically all of the material in one day and specifically identifying the points of interest for us where I think that we as a group of Wyckoffans need to pay more attention to the specific concepts. So I really appreciate you guys kind of like sticking through this long presentation, you know, being able, and I know in some instances you guys already really into the night, you know, really into early morning. So I appreciate your dedication, staying, asking questions, you know, following the thought process, following the logic that we are developing with each discussion. So it takes a lot of effort on your part. I realize that, and I'm really grateful that you do that for both yourselves and me in appreciation of my work that I put into this material. So one of the other thoughts here in this remark that I absolutely love and that I would put on as an advice to anyone who is present here or any students that we have, and that is that we need to restudy and repeat this knowledge again and again. Knowledge is available. I can give you the knowledge. I can give you the shortcuts. You can go to some other market experts, market teachers, market coaches, and extract the knowledge from them as well. What's important to do with the knowledge is to assimilate that knowledge in the most efficient way. And how do you do this? Only through the repetition of that. So I've realized early in my teaching career that I have to repeat the same concepts over and over and over again, and repeat them from different angles, give different narratives to the same idea. And at some point, for different people, it's going to click at different time. So it's extremely important for us to, a certain degree, you know, repeat the knowledge as well. So definitely I would advise, even with this workshop, not necessarily tomorrow, but maybe like in a week, in a month, come back. You're going to have the recordings, you're going to have the slides, and go and devote the whole day again to go through this material and make notes. And make notes and repeat those ideas over and over. And obviously there is a lot of time that I talk about how you build beyond your knowledge. And this is such a common question right now within our Wyckoff community that we've created with all of the people that attended all of the classes, because a lot of you are graduating to the next level of understanding and awareness about this material and the skill that is required to actually trade and execute this material. So the next biggest step for you guys, and I'm assuming that all of you are more advanced right here, you know, with all of these concepts, is skill building. You need to be able not just to remember the knowledge, but you need to be able to come to the class or come to the actual trading environment in real life and be able to see it as it unfolds. And that's going to take some time. And I'm still working on that with my own trading. And sometimes it could be frustrating. Sometimes you could make a trade and then you analyze the trade and you're just like, what? I saw this. Not only I know this, and not only I know this, but I saw this as it was unfolding. Why did I interpret this in a different way? So those type of questions need to be addressed, and they only could be addressed through practice and through more experience. After that, once you start building that skill of recognition of your analysis of that knowledge that you assimilated, the next step is to practice the execution. So trade what you see and see it in a correct way, in a very objective and not subjective way. And through the practice on the execution, this is where the majority of the profit is going to come. And those profits are going to be quite significant than the profits that you're already going to accumulate just through building your skill. So it's a natural progression for our students to have a lot of, I must say, probably difficulties with the material as they start, as they start, as they are being convinced that this is a valuable material to them in so many ways. They put more hours into this, and they put more hours than in the skill recognition. And after the skill building, this is where a lot of the profits are starting to come up in a very big, significant way. And I have different stories, and I usually share those, during this type of the conversations. I love when you guys are coming back to me and you're saying, I already paid, the market has already paid me for the cost of the course that I took from you. So thank you, and I'm really grateful to hear that. Another person might come, and this is a true story, and I'm just going to give you a couple of examples. Another person came to me and, she said, oh, thank you, I just remodeled my kitchen, just based on the trades that I made. So think about the remodeling of the kitchen. Another person comes in and, they're talking about how they utilize this knowledge, in a family environment, and they were able to make a grant to the university as alumni. Those are incredible stories. Those are the stories that we strive for to hear, based on the knowledge that we guys give you. So, I want to hear those stories. So once you have this type of stories, or if you have those stories, let me know, because that encourages me as well to stay passionate about my craft as a teacher, not necessarily as a trader, right? Because trading and teaching are two different things. But sometimes, I hit my kind of like roadblocks as well, whether it's as a trader or as a teacher. A question is, how do you keep the passion to keep going? You just grind it in a lot of spots. You don't want to do a lot of stuff, and you just create, the levels of accountability that are going to be appropriate for you to grind it. And the more you grind it, the more you understand, the more you do these things in the correct ways, the more internal encouragement you receive, and the more passionate you become about this stuff. And probably you kind of can sense how passionate I am about this stuff. And that's only because I'm doing this on the consistent basis. I'm constantly evolving as a trader. I'm constantly evolving as a teacher of this material, and that gives me more assurance that I'm on the correct path of mastery. So just at some of the spots where you're going to have some confidence issues about your trading in general, or about maybe even Wyckoff method, uh, grind it out. Grind it out. Go to the basics, and then start all over again. Identify where or something that you're doing incorrectly, and just grind it out to the point where you become knowledgeable about what you do, and then passion will come with that. All right, guys. I think that's it. Thank you for all of your comments. Thank you for being here. I'm really appreciative of all of you being here with me and spending the whole day. Um, it was a great workshop, at least for me. I feel very accomplished, with this workshop. I definitely see a lot of areas where I can improve on the delivery of this material, and I will work on that in the next December. If you want to come back and revisit this workshop, I'll definitely give you a discounted rate. And you're probably going to see a lot of this material, but which is going to be more refined. It's going to be more you know, determined in terms of how I deliver this. And there's going to be some new material, because each year I see some kind of much deeper understanding, with myself about why and how the market unfolds the way how it unfolds. So all of those new nuances and details that I catch they all go to the slides, and I give those to you guys. So really appreciative of you pushing me in that way, to be a better trader, to be a better teacher, and just really appreciative of all of your presence here in our community, and all of the interactions that I have with you. Have a wonderful holiday season. For those of you who are in the advanced Wyckoff course, I'll see you on Monday. For those of you who are in other classes, specifically in Market Outlook class, I will see you on January 4th. January 4th, January 9th are 2 free sessions, so consider attending those. And have a wonderful holiday season with your families. Thank you guys so much. Happy holidays and happy trading. I'll talk to you later. Bye-bye.